What if I told you that you could buy a home from a family member with little to no down payment and even secure a lower monthly mortgage payment? Sounds too good to be true, right? Well, it's not. This strategy is called a gift of equity, and it's one of the most powerful ways to purchase a home while keeping costs low. So stay tuned, because in this video, I'm going to break down how a gift of equity works and the specific guidelines for each different loan program so that you can take full advantage of this opportunity. So if you're planning to buy a home from a family member or even thinking about helping a loved one buy a home, this information could save you thousands. I'm David Zai, your trusted mortgage expert, and today we're going to dive into the gifts and gift of equity and what they are, how they work, and how they can help you secure a home with less out-of-pocket cost. A gift of equity is exactly what it sounds like. Instead of giving cash, a family member transfers part or all of their home's equity to you as a gift when selling you their property. This can cover your down payment and in some cases even help with closing costs, making home ownership much more affordable. But here's the catch. Not all loan programs treat gift of equities the same way, and there are specific guidelines you need to follow to ensure that everything is structured properly. That's why understanding the differences between FHA, conventional, VA, and USDA loan rules can make or break your ability to use this strategy successfully. And in this video, we're going to cover how a gift of equity can reduce or eliminate your down payment, which family members are eligible to give you a gift of equity under the different loan programs, the specific requirements for a VA, FHA, conventional, and USDA loans, and how this strategy can help you secure a lower mortgage payment. So stick around, because by the end of this video, you'll know exactly how to use the gift of equity to your advantage and take the next steps towards home ownership. So let's get started. When a lender considers the person giving the gift, one of the first considerations is whether or not a person is an interested party to the transaction. Interested parties are deemed to have a strong interest in the transaction occurring. So interested parties include the real estate agent, builders, developers, or other third parties such as nonprofits. It's basically anyone that would benefit as a result of the contribution. It is essential to understand that being an interested party is not bad and does not mean a gift cannot happen. It simply means that a lender may restrict the gift, which we will discuss later. Who can give the gift of equity? Understanding family member guidelines by loan types is one of the most important things to understand about a gift of equity. Not all loan programs define family the same way, and in some cases, there's no family relationship requirement at all. Knowing these differences is crucial, because choosing the right loan program can determine whether or not you're able to use a gift of equity in your home purchase. Government loans such as FHA, VA, and USDA have way stricter definitions of family members. The person giving the gift of equity must be an eligible family member as defined by the program guidelines. So here's who qualifies: parents, step-parents, and grandparents; children, stepchildren, foster children, or adopted children; siblings that include step and half siblings; aunts and uncles; spouses and domestic partners; in-laws such as mother-in-laws, father-in-laws, brother-in-laws, sister-in-laws, and other in-laws; and legal guardians. This means that if a person is selling you their home is not an immediate or extended family member, under these definitions, you won't be able to use a gift of equity with the FHA, VA, or USDA loans. So let's go ahead and flip the script, and let's move on to conventional loans. Your Fannie Mae and Freddie Mac loans, they definitely have a lot more flexibility. Unlike government-backed loans, conventional loans do not require the seller to be an existing family member. They just need to have a legitimate documented relationship with the buyer. Those are all the family members that we just listed under the FHA, VA, and USDA rules: fiancés and domestic partners, godparents, former step relatives, and close long-term family friends with proof of relationship and lender approval. Because conventional loans allow more flexibility, this option can work well if the seller isn't an immediate family member, but has a long-standing personal connection with the buyer. Why does it matter, you may ask? Because choosing the right loan program isn't just about the best interest rate. It's also about making sure that you can maximize your benefits when using the gift of equity. Knowing who qualifies as a family member under different loan programs can be the deciding factor whether or not it's the strategy that works for you. So stay tuned, because up next, we're going to break down the specific documentation requirements you'll need to properly structure a gift of equity so that lenders will approve it without any issues. Now, depending on the loan programs, a lender may limit the gift amount. For instance, there may be a limit on the total amount of gift or gift of equity that can be used for total closing cost, or gifts that can be used for both closing cost and down payments. We then must consider whether the gift giver is an interested party or what those restrictions may be. For example, in some cases, a type of property where a gift can be received is limited, or even the amount of money that the borrower has to contribute from their own funds to their down payment or closing costs may be required. For instance, gift funds cannot be used on investment properties, but they can be used on primary residences and second homes. There are many facets to consider, so understanding the differences between the loan programs can help you in the long run. But before I go into different loan program requirements, here are a few fun facts you can use as buyers or if you're a seller to your advantage. Freddie Mac is the most flexible conventional option if an interested party gives you the gift. However, they apply limits to the gift, which I'll discuss in a moment. Neither Freddie Mac or Fannie Mae allows a gift from an interested party to be used as a down payment. However, that doesn't mean it cannot be applied to closing costs, just not down payment. Freddie Mac does not require a borrower's own funds on a 1 to 4 unit property unless the gift contributor is an interested party. Additionally, if the borrowers use the Home Possible program and purchase a 2 to 4 unit owner-occupied property, then Home Possible only requires as little as 3% down of the borrower's own funds. This differs from the standard Freddie Mac loan, which needs no borrower funds. It appears that Freddie sees the Home Possible as a higher risk than their standard programs, and it has lower mortgage insurance coverage combined with a borrower who may be a landlord for the first time. This may be why they require a borrower's own fund requirements that cannot come from a gift or a gift of equity. Now, here's a great one for wedding seasons, and one that I think is not utilized enough. Freddie Mac will allow wedding gifts to be deposited within 60 days of the date of marriage. We only need to provide a copy of the marriage license, and all those gifts count regardless of family status. FHA will also allow real estate agents who is also an eligible family member to gift their real estate commissions to the borrowers. This can be used for the down payment and the closing cost. FHA used to be the go-to loan for wedding gifts, but not anymore. Their new guidelines are silent on this subject, so many lenders don't allow wedding gifts as a source of funds. But as I mentioned, wedding gifts are definitely Freddie Mac's domain now. And here's something mind-blowing to me. FHA does not use the word fiancé or fiancée as an eligible gift donor, but allows domestic partners or someone who is a close friend with a clearly defined or documented interest in the borrower. Since the state defines domestic partner status, this could mean different things. In general, defining a domestic partner means proving that the couple has resided together for a period of time. Fannie Mae and Freddie Mac mentioned fiancé, fiancée, or domestic partners in their guidelines as an allowed person to give a gift. See how confusing it can get? This is why we work together. We can work out all these issues before a contract is signed. USDA and VA keep things simple. If you get a gift, that's great. No family ties are needed to be established. Next, I'd like to review the general guidelines of the different types of loans and programs. For a conventional loan, there are two types, okay? There's Fannie Mae and Freddie Mac, and they are conventional loans that are, for the most part, pretty close to what they allow. However, there are some differences, so let's look at those. Both agencies are aligned on family status, as long as the gift is coming from a borrower's spouse, fiancé, domestic partner, child, or other dependents of any individual related by blood, marriage, adoption, legal guardianship, or trust or estate of a related person. They meet the requirements of the family status. Both agencies allow gifts and gifts of equity on a borrower's primary residence. They also do not require that any money coming out of a borrower's own funds on a 1 unit. However, Fannie Mae gets a lot trickier when we talk about 2 to 4 units. Fannie Mae will require 5% of the borrower's own funds and Freddie will not. Here's something a lot of people don't know. Even though Fannie Mae requires 5% of a borrower's own funds on a 2 to 4 unit property, if the borrower receives a gift from a relative or domestic partner who has lived with the borrower for the last 12 months, fiancé or a fiancée, the gift is also considered the borrower's own funds and may be used to satisfy the minimum borrower contribution requirement as long as both individuals will use the home being purchased as their primary residence. So, if a borrower doesn't meet the definition of having their own funds and is relying on a gift or gift of equity on a multifamily property, then Freddie Mac is the way to go because they don't require the borrower's own funds. Gifts and gifts of equity can also be used on second home purchases. However, if the loan value is more than 80% of both agencies, the borrower must have 5% of their own funds, and neither agency allows for investment properties. Freddie Mac is a little bit more flexible on the interested party contributions, so if the seller has no affiliation with the other interested parties, such as a nonprofit, they do not consider the gift or gift of equity as an interested party contribution. And the last tidbit to know is that Fannie Mae and Freddie Mac do not distinguish between a gift of cash and a gift of equity, so it's the same for them. Now, let's move on to FHA. It seemed like it used to be that anyone who needed a gift used FHA financing, but that is no longer the case since Fannie Mae and Freddie Mac have adjusted their guidelines. FHA has different definitions of family status and defines these statuses more specifically. It also is important to note that anyone who meets the following relationship is considered family, regardless of actual or perceived sexual orientation, gender identity, or legal marital status. They allow child, foster child, parent, or grandparent to give you a gift. Yet remember, we talked about FHA not mentioning fiance versus fiance status that Fannie Mae and Freddie Mac allow. FHA loans only use the word spouse, domestic partner, or someone who is a close friend with a clearly defined and documented interest in the borrower. FHA will also allow a legally adopted son or daughter, brother, stepbrother, sister, stepsister, uncle, aunt, and in-laws. In comparison, Fannie Mae and Freddie Mac leave a little bit of latitude in their guidelines by saying that any individual related by blood, marriage, adoption, or legal guardianship. FHA defines this in more detail. Little nuances like this must be vetted out when you're picking the right loan structure for you. FHA does distinguish between gifts and gifts of equity, whereas Fannie Mae and Freddie Mac do not. This distinction can cause many issues, so let's take a look at that. FHA says that cash and gift can be used as a primary residence on 1 to 4 units, and no minimum investment is required by the borrower. So all down payments and closing costs can come from a gift. However, this gift must be documented and no cash on hand is accepted. Lenders must show the donor's ability from their bank statements and document the transfer. FHA also allows a donor to borrow the gift money. Either way, the lender must document that the gift donor has the available funds to gift. The only other condition is that gifts cannot be used to fulfill reserve requirements. An example of when a file may be required to have reserve requirements, which is essentially additional funds in their account after closing cost and down payment are deducted, is a manually underwritten loan. All right, let's move on to gift of equity. For some reason, FHA is pretty tight on gift of equities. They must have had fraud issues that have popped up due to gift of equities. If you have a gift of equity, the loan to value is limited to 85% unless the borrower purchases the primary residence of another family member. Remember how a family is defined. Or a purchasing family member has been renting the home for 6 months before the sales contract date. For example, let's say the parents spend more time at their second home in another state because they're nearing retirement. Yet, they still haven't sold their former home. So, one of their children decide to rent it and care for it while the parents are elsewhere. If that child rents the house for 6 months before the contract, then the parents can gift as much equity as they want to the child renting the property. However, if it's less than 6 months or the child has not paid rent, then the loan to value is limited to 85%, which means that the borrower needs a 15% down payment. Unfortunately, I've seen this happen too often. So planning this before the contract is signed is essential. So now let's move on to the easiest programs for gifts and the gift of equity, USDA and VA. Neither VA nor USDA have a family status requirement. Their only requirement is that the gift or gift of equity does not come from an affiliated person in the transaction. So related real estate agents donating their commission or other funds means that you cannot help out on a VA or USDA because you would be an interested party. However, as we discussed earlier, you can gift on other programs. See how they are flexible? But another program may be better for a borrower based on a particular circumstance. Cash gifts can be used for anything, but USDA does not allow gifts for required reserves if any are needed. VA has no guidelines on this for gift of equity, but USDA states that the appraiser must be aware of the gift of equity and the borrower may not receive cash back at closing. If you're considering using a gift of equity to buy a home and you want to explore your best loan options, my team and I are here to help. Click the link below to connect with us and get started. We'd love to walk you through the process and make sure you're set up for success. And if you found this video helpful, don't forget to like, subscribe, and share for more mortgage tips and strategies. Thank you for watching, and I'll see you on the next video.